The intention of today is really to provide an opportunity for ourselves via Grant Patterson, our CIO and founder of Providence, to articulate our current thoughts and views in this very volatile environment. As you can imagine, we've had active dialogue with our clients over the course of the last month and elevated level of communication within our investment committee. We felt it was opportune for us to share our thoughts and views with our network and those that have a close interest in following with Providence. So without further ado, I'll hand it over to Grant, but thank you very much for listening today.
Thanks, James, and thanks everyone for joining us today. I hope we can just impart a little bit of our thinking, which is through the connection with our investment committee. It's obviously been an incredibly volatile time, the most volatility I've ever seen in over 40 years, and just trying to get a feel for where we are in this current turmoil, I thought it would be useful perhaps to share our thoughts. I mean, generally, our dialogue over the last 12 months or so has been that valuations were very stretched across all asset classes, and therefore we were running a fairly conservative portfolio because of those valuations that were stretched. In a way, I think the coronavirus was really a trigger for a readjustment of valuations rather than cause. So the portfolios going into this were the most diversified we've ever been in the 20 years that the business has been operating. We had a reasonably high level of cash of around 15% on average. We had gold in the portfolio and bonds. So overall, the portfolios for clients have held up pretty well, probably down around 6 or 7% for the financial year to date. It's more important now about what do we do about that, and I thought I'd just share some of our thoughts with you. So currently, where are we in this correction? As I say, it's been so volatile, it's hard to keep up with all the changes. So the US equity market, the one thing I wanted to remind everyone here is that last year, starting in January, we had an incredibly strong run in the markets. It's up 44%. And this is where we're saying that valuations were very, very stretched. Well, of course, we've had a very, very sharp downturn. The market at its lows was down about 34%. It has now recovered some of that, and last night was a very strong move. So the market, the S&P at the moment, down around 22% from its high. The ASX has also fallen quite heavily, as you can see there, particularly in US dollar terms. I've just redone these numbers this morning. So in US dollars terms, the ASX 200 is down 36% and down 27% in local currencies. And I think it's interesting from a US dollar perspective in regards to a number of our assets. With the weakness of the Australian dollar, some assets here in Australia will look quite attractive to US dollar investors. And in fact, we have to go back to April 2009 to find a point where the ASX was at this sort of level in US dollar terms. The volatility, as we all know, has been exceptionally high, nearly as high as what we saw in the GFC. And you can see there the spike volatility, or the VIX index tends to be sort of the fear index, if you like. This sort of level indicates that you can expect daily moves in the order of 4 to 5% in markets, and that's what we're currently seeing as the markets are getting whipped around by the volatility. I think one of the things about the volatility that I'd just like to point out is that I think a lot of this has got to do with the structure of markets that have been developing over the last 10 years. There is a very, very big influence of computer trading and algorithmic trading and high frequency trading that's having a big impact on markets. And I've said for some time that sometimes there's an illusion of liquidity in listed markets, whereby the view is that there's always liquidity in the market. Well, there is, but it comes at a price. And we're certainly seeing at the moment there's not that much liquidity in the market because we're seeing such high volatility going through. In regards to the A-REITs, the listed property sector, also down quite sharply since the February 20 high, down nearly 50% in US dollar terms and around 42% in Australian dollar terms. So they've had a very large fall and may start looking attractive, particularly for offshore investors. We have included gold in the portfolios about 6 to 12 months ago, just as a risk management tool for our portfolios. I think it's important to note in Australian dollar terms, which is where we're exposed, the gold price has performed exceptionally well and has certainly given some protection to our clients' portfolios. We're retaining that position in portfolios more as a risk management tool rather than an overall view of where the gold price is going in the short term. In regards to government bond yields, as we all know, have been falling for some time. It's hard to remember back to 2008 where government bond yields were trading around 6%. Well, we're a long way from that now, with US 10-year bonds currently at 0.86% and Australia 10-year bonds at 0.92%. So very little inflation expectations built into the bond markets. Now, the credit markets is an area that has been concerning us for some time. And the reason there has been that over the last few years, given the cheap money that's been available and the central bank flooding the system, corporates have been incentivized to raise additional debt to buy back their own equity to a stage where we now have record non-financial corporate global debt. And the quality of that debt has been declining as people have been happy to take on more risk to try and search for yield. These two charts are just showing what's happened since we've had this correction. Credit spreads, which is the interest rate you receive over the risk-free rate, has widened quite substantially. That first chart is investment grade debt, and you can see that the credit spreads have blown out from about 100 basis points over the risk-free rate right up to around about 400. And the area that concerns us a little bit here in this investment grade, over 50% of investment grade credit is now in BBB rated paper. And BBB rated paper is only one notch away from basically junk or high yield. So we're a little bit cautious there that in this economic downturn that we're likely to have, that a number of companies are going to get downgraded, as we saw just recently with SoftBank. And I think that the credit market is still quite vulnerable to some shocks. It's certainly not trading at the moment. There's very little transactions going on and certainly no new issuance. However, we're not as high as where we were in the GFC, where investment grade spreads blew out to around about 600 basis points over the risk-free rate. And similarly in high yield, we've seen a big spike in the high yield spread up to around about 1,000 basis points or 10% over the risk-free rate. That's indicating defaults in the order of 10%. So we're starting to get there. Certainly not as high as where we were in the GFC, but we have seen some widening in those credit spreads. In regards to the Australian dollar has done its job for us, if you like, in protecting the portfolios. Our international equities are held in offshore currency. The reason why we do that is because we feel that if there is a major correction in risk assets, normally the Australian dollar gets hit. And that's certainly what we've seen over the last few months, coming off a recent high of around 70 cents down to around 55 and back to around 60 cents. This is taking us back pretty much to pre or GFC lows at these sort of levels. And we're actively looking now whether we hedge part of our international equities back into Australian dollars, given the level of the Aussie dollar at this current point in time. In regards to stimulus, the markets obviously needed an enormous boost. Liquidity was pretty much dried up and shut down. The plumbing wasn't working, if you like, in markets, and particularly in credit markets. And certainly we've now seen a call to action. As of Friday, there was a total of nearly $6 trillion in global coordinated stimulus, which represents about 6.75% of global GDP. Just for some context, the stimulus package during the GFC was approximately 3% of global GDP. So this is a very, very big concerted action that has been taken. And certainly last night in the equity markets, we saw some relief in regards to what was coming out of the US. However, I just want to go through where valuations are at the moment. We've always held the view that valuations do matter. They tend to revert back to the mean. It's just very hard to know what that trigger point is going to be. And obviously, we've had the black swan event here with the coronavirus that started to bring valuations back. So I thought it might be useful just to try and get rid of all the noise, to have a look at where markets are and where asset classes are, and whether it's time to start having a look at deploying some of that cash.
Glitch with Grant just while we wait for him to be restored as the NBN gets pressured around the country, as we can all probably appreciate. I'll just highlight, and apologies for interrupting, Grant, I'll just highlight for listeners, either at the top of your screen or at the bottom of your screen within Zoom, there is a small icon called Q&A. There is the ability for you to be able to log questions, and at the end of Grant's presentation, we will work our way through some of those questions. So please feel free to ask them. Any questions that we don't get to answer through the call, we will endeavour to follow up with you after the webinar. Back to you, Grant.
Thanks, James. So when we're having a look at valuations at equities, we have a look at what's called the Shiller PE, which is a 10-year average of earnings to try and take out the volatility that you get from year to year, to have a look at where PEs might sit. And as you can see on the left, in the US, we've had a big derating of that PE from around about 32, 33 times, and getting back towards longer term averages at around 20 times. So we're getting back there to what the average has been. I would argue that the uncertainty is such around the globe that you'd be wanting to buy below average to reflect the risk that is currently in markets, but that has been a big derating back towards fair value. Same in Australia. We're now just below the long-term average in Australia of around about 15 times. So that's starting to indicate to us that on a longer term basis, we're starting to see valuations now back to their averages rather than being extremely expensive as they were at the beginning of this year. One thing that we watch quite closely is the equity risk premium. So the expected returns that you can expect from equities above bonds. And if we have a look at past history, a sort of turning point, if you like, in markets was around about an equity risk premium of 7%, which we can see back here in the GFC. So trying to have a look at where we might be at the moment, part of the equity risk premium is that what the current PE is, and of course what earnings you expect going forward, to try and have a look and judge that. So what we've got here is that if earnings declined 15%, which I think would be a minimum, and just went back to their longer term earnings growth, then we're certainly at a point above 7%, which would indicate the market is looking good value at this level. This is the US, but it's similar here in Australia. However, if we think that earnings are going to be down 35%, which I think is more plausible, we're not quite there yet, but we're getting there. And then we have a look at where the current forward PE is sitting at the moment. The market is now implying an 11% downgrade to 2020 earnings for the S&P 500. If we feel that the market is going to decline in earnings sense of 10%, then this PE is around about its long-term average, that green line. However, if we think earnings are going to decline more than that, and let's say 20%, then the market still has some way to fall before we get back to long-term averages. If we target that 25% earnings downgrade for the market and expecting the market to go back to long-term average, that would still indicate there is downside of 20% from current levels in the equity markets. Now, what the ultimate fall in earnings is going to be is very, very difficult to judge, obviously. And also the second part of that is how quickly earnings are likely to rebound. In the ASX, the Australian Stock Exchange, similar sort of story. If earnings only decline around about 5 to 10%, we're back to long-term averages. However, if we target a 25% decline in earnings, we still have some way to go before we get back to fair value. When we have a look at valuation in the A-REITs, there's certainly been a restoration of value, if you like. The implied cap rate of the sector has now moved above 7% from a low of around about 5%. And certainly against the spread against the Australian 10-year bond rate, implied cap rates look quite attractive compared to long-term averages. And we've also seen the sector move from a 20 to 30% premium to underlying net asset values and coming down now to slightly below, around 10% below net asset values. And once again, from a US dollar perspective, that would start looking quite attractive. We would expect that there'll be some significant cuts to distributions, as we're aware, in regards to income coming from either shopping centres or any of the tourist-related assets. We were expecting quite significant downgrades to the income. In regards to valuations and inflation, bond inflation expectations are extremely low, and that's not surprising that there is no sign or fear of any inflation in the short term when you have a look at bond yields. One thing that is on our radar screen that we're watching closely, that once we get through this health scare and things settle down, there has been an extraordinary amount of stimulus put into the system. And arguably we'll see a pickup both in consumption and the manufacturing sector, and that could start having some implications in regards to inflation. And so we will be needing to watch that quite closely, but at this stage, it's not an immediate concern. When we have a look at credit, spreads and defaults, as I mentioned before, the credit spreads have started to widen, which would suggest that default rates, which is this red line, would start moving up to around about the 10% level. And we think that that is likely. So we're expecting to see some pickup in defaults. Whether that assumption of 10% is enough, we're not quite sure yet, but it's certainly going back to previous levels, bar the GFC. And as I mentioned before, the Australian dollar has had quite a derating. we have a look at that over history on a real effective exchange rate, the Australian dollar is starting to look reasonable value against its longer term average, both on a real exchange rate and a PPP basis. And that is probably prompting us to have a look at hedging part of our international equities back into Australian dollars. So I just wanted to touch on risk management and the way in which we're managing our clients' portfolios from a risk management point of view. We very much have the mandate of the protection and preservation of capital in real terms for our clients. And in our 20 years of looking after clients' wealth, we've been able to do that. And I just wanted to give you a feeling for where we feel the risks are at the moment and how we're managing those risks. So part of the risk management asset allocation, if you like, in our current client portfolios, as I mentioned, we have our international equities in offshore currencies. So the weakening Australian dollar gives us cushion against those risk assets. We've had a weighting to gold in the portfolios, given the uncertainty that was around and the high valuations in risk assets. We've had a reasonable level of Australian government bonds, around about 10% in the portfolio, as giving us some protection. And in fact, not only have they given us some protection, but given the fall in yields, it's actually been a very good performance in that asset class. In regards to style, we're very much a value-based type house where we do believe that value does matter. And so the fund managers you can choose from can have various styles, whether they be growth, momentum, or value-based. And over the 20 years, with the 4 or 5 international fund managers that we've had that are all value-based, over that 20 years as a collection, they have outperformed the market. At certain times, different managers underperform and outperform within the group, but as a total, the combined group has outperformed the market, and we've just had a look at how they've performed during this period of time, and they've significantly outperformed the downside that's been occurring in the market, which would be our expectations. And in regards to cash, we've been running with an overweighting to cash, despite the lack of income coming from that. Sometimes we're questioned about why you'd have money in cash because you're not getting enough of a return. My view on that is you don't know what your return is on cash until you spend it. And that's when you want it, when markets dislocate, that you can go and buy attractive, cheap assets, and then your return on cash is quite significant. But in saying that, in where our portfolios are at the moment, and as part of our risk management strategy, we've never been as diversified in our history than where we are at the moment. And that is unlikely to change in the short term. So, in amongst all the noise and the volatility, it's very difficult sometimes to try and work out where we're at. And at Providence, what we try and do is make sure we get rid of a lot of that noise and be very clear about what we're looking for in order to deploy capital after such a big correction. I thought I'd just share some of the areas that we're watching closely and where we may be in regards to that decision. As I mentioned at the beginning, one thing that we watch quite closely is the equity risk premium. And as you saw from those previous charts, we believe that we're pretty much there on that basis. Gets a green tick from us that the equity risk premium is now at a level that looks attractive. As mentioned in regards to the stimulus, we're now seeing enormous stimulus in the system of over 6% of global GDP, and that is a positive from our perspective. And also in regards to fear, as the volatility index probably indicates, and certainly what we've seen and been reading over the last few weeks, investors have been very fearful, and therefore a lot of the bad news in our view has been built into the market. In regards to the more neutral settings, credit spreads have widened to a stage where they're indicating a mild recession. So that's a neutral for us. We're not quite sure that there's enough built into credit spreads yet to the dislocation that's likely to come from the economies. So that's a neutral. Valuations, as I pointed out before, have come back to nearly long-term averages, depending on what you think the earnings downgrades are going to be. And so they're not ultra cheap, pretty neutral at this stage. And liquidity, although that's improved quite significantly in regards to the central bank stimulus, there's still a lot of signs of the plumbing, if you like, in markets not functioning, particularly in credit markets. And so that's a neutral for us, improving but not there yet. Where we've got sort of the red lights and haven't got confidence yet that everything's built into the market, the high yield spreads we believe are still have further to widen to reflect the downturn in the economies. Volatility is still very high, and it's very difficult to invest in markets when you're getting whipped around by 5 to 10% every day, and we'd like to see that volatility stabilize for some time. Momentum is still not positive, if you like. 1 or 2 days we've seen some positive momentum and then it gets hit again. We'd like to see more steady positive momentum before being comfortable that the markets have stabilized. Earnings revisions are only slightly down, in the order of 5 to 10%. We believe there's a long way to go yet to get the earnings revisions down to where they need to be. And we're yet to see any corporate defaults, and we're expecting that to come through. And once that comes through, we'll be more confident that we're getting further through the system. I mean, if I go back to my experience back in 1987 or even the GFC, and particularly in 87, we had a very sharp decline in markets in a very short period of time and quite a sharp move. But it took 6 months, 12 months or 18 months before the impact of that decline to filter through to some stress in corporates or in certain assets. And we don't think this will be any different this time around, although it's been very sharp and very short in regards to the readjustment of valuations. There will be some structural damage done to corporate balance sheets and to certain hedge funds and to certain managers. And that's why we believe it's still opportune to be patient and wait for those sort of opportunities. Because in our view and the view of the investment committee, we really want to buy assets that are cheap, not that are just fair value, given the uncertainty that is in the economies at the moment. So in summary, valuations are starting to get back to fair value in our view, but the risks are still elevated. There is some question over long-term multiples. Given the low bond rate, the argument is you can justify a higher PE because of the low bond rates. The question that we've got is that the market has been paying very, very high multiples for growth companies that have been derated very quickly. And we think with this current volatility, there'll be some real questions raised over whether paying those high multiples is a strategy that will protect your wealth. So we'd be expecting multiples to come back to long-term averages and probably below, despite the bond rate. We want to remain very diversified, reflecting the risks that are in the market. We will be patient, waiting for those opportunities. We'd like to see more stability in the markets to feel that they're functioning correctly. I mean, given the day-to-day move, you cannot assume from any day-to-day move that that's a real reflection of the underlying value of these assets, because they're being whipped around so much, as I mentioned before, by technical trading. And we believe that it's very important in this environment to continue to protect and preserve capital. We're not employed by our clients to be a hero. We are looking for opportunities. The portfolios are in good shape, but we do believe that there'll be some collateral damage, and we're looking across all asset classes as to where we may find some value. So with that, James, I might leave that over to you. As I should with the disclaimer, this is general information only and not specific. James, if there's any questions, I'm more than happy to receive that, or any of the other team, Harry and Mike, who are also online.
Thanks for that, Grant. So just as I mentioned before, for those who are listening in, either at the top or the bottom of your screen within the Zoom application, there is a small box that says Q&A. You can click on that and you can ask questions, and we will endeavour to work our way through as many questions as we can. Also, while I'm speaking, if there's anyone who has dialed in via telephone and you have not been able to see the presentation, please make yourself known to any member of the Providence team after this call, and we will send you through the presentation. As Grant mentioned, we've got other members of the investment team on the call as well, Michael Ogg, William Porter, Harry Buckeridge, so we can defer questions to them if need be. I'll start with the first question here. Are you seeing the current uptick in the market over the last couple of days as being short-lived?
I don't know. There was a call from the technical parts of the market that we tap into a couple of days ago. So the technicals certainly were indicating that the market was oversold and was expecting a technical rebound, and we've certainly seen that. There's been nothing to suggest to me, well, besides the stimulus getting through in the States, which is a change, which is a positive, we still don't believe that we're at a level where valuations are very cheap. And so, no, we don't believe that it's an indication that the market's ready to take its upward path again.
Okay, thanks, Grant.
Now, sorry, in saying that, James, I mean, all stocks don't bottom at the one time, of course, and there's a huge dispersion now in performance of stocks with the volatility. So the proviso there is I'm talking from an index level, not from a stock by stock level.
Okay, thank you. The next question is, what is your view on hybrids?
Michael, I think that's your favourite topic, so I'll let you go on that.
Yeah, I wouldn't say it's my favourite topic, but it's definitely my pet peeve. Look, hybrids are sort of polarising. People will love them or hate them. We're somewhere in the middle. For quite a while, people have been selling hybrids as replacements for term deposits, which we've never agreed with. Essentially, they're equity dressed up as debt. They have convertibility into equity. They have divvy stoppers. They're quite complex beast hybrids. And we have had hybrids in the portfolio, but we did sell them about a year ago. When we're getting yields of 3% for hybrids, we didn't feel being paid enough to take that risk. But now we're getting about 10 to 11%. So we are revisiting hybrids, but they still are quite illiquid. So even though they're much better value than they were a year ago or even 3 months ago, if you're looking to go invest in hybrids, it's an illiquid investment, so getting set's quite hard. And then once you are set, if you do want to retrieve your money, selling can also be hard. So hybrids look much better value than they did 3 months ago, but so does everything in credit land. So loans look good, asset back looks very good, REITs look good. So it's a question about, do you want to give $1 to hybrids, or do you want to give $1 to another part of the credit market? But in summary, they are looking much better, and we are looking at them at the moment.
Yeah, I think that's right, but I think you're getting paid for the risk now, and therefore that they may be a opportune time to include in the portfolios. But as Mike said, the volume is very difficult. We've been investing for clients in senior secured first mortgage completed property loans, where the yields there have been 7 to 10%, LVRs of around about 50%, and it's no development risk, no construction risk, first mortgage fully secured. That market looks interesting still to us, and that's quite attractive area. And as Mike, we spoke about this morning, we're reviewing one of the fund managers who have asset-backed securities. Yield to maturity on those asset-backed securities are now over 5%. We think that looks attractive as well for income for portfolios.
Okay, thank you, Grant. Another question here is asking if you have a view on emerging market equities at this point.
We don't have a strong view, James, on the relativities at the moment, I'm afraid. We tend to feel here in Australia that we have such an exposure to emerging markets through our structure of our equity market. We tend not to allocate directly to emerging markets. We allow that, we rely, if you like, on our international fund managers. So I know that they've struggled for some time. I'm not convinced that while risks are elevated, that's probably the best place to look at, given the volatility. But I don't have a strong view, I'm afraid, one way or the other.
Okay, thank you. Another question is, do you see any opportunities currently, or is it too early to comfortably think about deploying cash? You partially answered that, but I just thought I'd let you just sort of elaborate on that a bit more.
So the area of opportunity at the moment is having a look at the currency hedge. So I think that's something that's worthwhile considering, and that's not about, what's the level of the Aussie dollar today or tomorrow. It's more about protection of the portfolio. So we're certainly looking at that. I think that REITs look interesting at these sort of levels. We've just got to try and get our heads around the income drop that's going to come through with the deferral of rents. But this should be a deferral, and I think from all the feedback I've had from all our property fund managers, the banks are very, very supportive of helping these assets through this period of time, as opposed to the GFC. And so I think the REITs selectively look interesting, and once again, particularly from an international perspective, from where the Australian dollar is, I think my view is that there is some value back in that sector, and we're looking at that quite closely.
Thanks, Grant. There's a question here just talking about the significant falls in both Australian share markets and international share markets. The question is, how have client portfolios performed in the course of the last couple of months in light of the significant falls in equity markets? Yes, they're looking for a bit of a comparison.
Well, Mike, correct me if I'm wrong, but the financial year to date, on average, the portfolios would be roughly down 7%, probably 6 to 8, something like that.
Yeah, I think 4 to 8.
4 to 8. From the peak, the 20th of Feb, I think they would. I haven't had a look at them the last day or so, but probably around about 10. I think, Mike, is that right, or 10 or 11?
Look, Grant, it sounds about right, but it's a moving feast with any given day it's different, but sort of 9, 10 from the peak sounds about right.
Yeah, and that was sort of a few days ago when the markets hadn't rallied. So and that's consistent with our expectations. that, you know, we were, you know, I guess setting the portfolios we hope for single digit falls in a correction, and this has been a pretty good shake. So they've done their job, if you like.
Thanks, Grant. And we might make this the final question. And if there are any further questions that anyone on the webinar wish to be answered, please feel free to contact us directly, and we will endeavour to follow those up. And also any other questions that have been polled, we'll also follow those up in due course. A question really is saying, what is your key catalyst to start deploying cash into risk assets? I know you touched on that, but if there was one or two key catalysts that you'd be looking for?
Well, if we're talking about equity markets, it would be the earnings revisions have come through to the market. So we would be looking for the earnings revisions to have come through, and we'd be wanting to see forward-looking PEs around or preferably below long-term averages. I think the thing that is still worrying us most is the outlook for credit and defaults in the system, remembering that we've gone into this correction with record levels of corporate debt. And I know interest rates are cheap and going to stay cheap for a long time, but the leverage is very high. You know, we're starting to see, you know, some real stress in that area. So to answer the question, I guess valuations back to long-term averages or below, earnings revision coming through, and start to see some of those corporate defaults working through the system rather than ticking along in the background. I mean, I thought it was very interesting, and, you know, this is the whole second derivative or third derivative that tends to happen, you know, later on down the track, but there's already some stresses. I thought it was very interesting, the decision by some industry funds to downgrade their unlisted illiquid assets in valuation by about 7%. And I couldn't quite work out why they'd done that so quickly, but it came clear to me that they were under some liquidity problems. As people were, as the listed market was downgraded, obviously from, you know, falling quite heavily, and their members taking money out, if they were able to, from their super, out of cash, what I think happened is the unlisted illiquid investments that the industry funds have been buying substantially over the last couple of years became too big a part of their portfolio. That meant that they may have started to breach some of their mandates. So by winding back those valuations, which is probably a correct thing to do in the sense of where the valuations are, I was surprised it was done so quickly, and I suspect that had to do with redemptions. And of course, the government has announced that people can take out $20,000 from their super fund. I mean, if everyone did that, that's about $74 billion. So that's a lot of cash to come out of those funds. But we'll wait and see. And just in regards to this presentation, James, I'm more than happy if anyone wants to send this around to their contacts around the market or their colleagues. It's a very uncertain time. This is our considered approach. And if you feel that any of your colleagues would benefit from, you know, having a listen to what someone is thinking about in this place from an independent point of view, I'm more than happy for this to be shared.
Thank you very much, Grant. With that, we may now conclude the webinar. So on behalf of Providence, thank you for all of those who have joined today. As Grant mentioned, we will have a link available which will have a recording of this webinar that we will send through to you later today. And for those that dialed in on the phone line, if you would like to see a copy of the presentation, please make yourself known to anyone at Providence in the course of the next day or two, and we'll also send you through the presentation. And anyone who also has any further questions, or for that matter would actually like to speak to any of us about our thoughts and views, your calls are always very welcome. Thank you for joining us today, and thank you, Grant.
Thanks very much, James. Thanks everyone for joining us.
Thank you.
Stay safe.